So Casey, this question asks, what do these two have in common? First blush, I would look at this and say absolutely nothing.
Yeah, I don't know if Alan Greenspan's ever scored 35 points or 50 points in a basketball game or not, but I'll give you a hint. Michael Jordan is holding a pair. Yes, we are talking about underwear. So what is the connection now in Greenspan? Well, it's the men's underwear index and what underwear says about the economy. In the 1970s, when Alan Greenspan, the former chairman of the Federal Reserve, he was running his own economic consulting firm. And he said that he looked at sales of men's underwear as an economic indicator. Underwear sales are normally stable, but dip when people are cutting back spending. So his theory was, you don't see underwear. The spending on men's underwear is going to be the first discretionary item to go. And when people are feeling confident, they spend more and hence underwear sales increase. So let's look at the tape and see if this theory bears fruit. So what we're looking at is a stock chart of Hanes brands. So there's the connection to Michael Jordan. He's been a spokesperson for Hanes brand for several years. On the bottom left of the chart, the line you see is the price of Hanes brands right at the time of the presidential election. It was just under $13 a share. And then a few days after the election, news of the success of the COVID vaccine broke. And then you start to see the stock climb in the next few months, up to $15, $16 range. Then you're going to see a sizable jump in the stock price in February, right after the news story that the stimulus relief package, it was approved by the House Ways and Means Committee, setting it up for a vote in the House. So with the likelihood of more stimulus coming, the price of Hanes brand stock jumped with the anticipation of sales increasing. So I'm either going to put this in the camp of either Alan Greenspan's underwear index was spot on, or we have an example of confirmation bias, where you seek information to support a belief, but I'm not going to question Alan Greenspan's wisdom here. So, we're coming off a very strong year for stocks. And a question we've received from many of our clients is, what comes next for the stock market going forward after such a strong rebound in stock prices? It's understandable that many investors, they're worried these gains, they came too far, too fast, but the ingredients are there for the bull market to continue. You've got history provides a very consistent message for the second year. It's smaller market gains, stronger earnings, and economic growth. Now, in the last year was that first year we experienced in the bull market, we saw stock prices move up faster than earnings. So this relationship of prices relative to earnings is called PE ratios. Those climbed higher, meaning that stocks became more expensive. Now, in the second year of a bull market, it's defined more by earnings growing faster than stock prices. But you can have the P and the E, and that PE ratio both can go up, but the expectation is earnings will grow at a faster pace than stock prices. And this would help ease the concern that stocks are a bit overvalued. So if you have an earnings resurgence, it should be a tailwind for the bull market. It'll compress PEs. Short term, though, the risks are we've got excessive optimism, near record valuations. But when you go back in history now, let's look at the bottom part of this chart. When you look at stock price returns dating back to 1950, you can look at some of the data, see how stocks performed after you've had a 50% move or more. And so we reviewed those returns over those rolling 12-month periods. And when you look at the next 1 year, 3 year, and 5 year time periods, it's not surprising that the 1 year following such a big year would drop off a bit. That may come in the form of low returns or possibly slightly negative, as we've seen in history. However, the further you go out, the better the returns. So there wasn't a single 3 year period following a 12-month gain of 50% or more that showed a negative return. And there's only one 5 year period with a loss. And the average of those numbers that we're looking at over the 3 and 5 year periods, it's 7% over the 3 year, 11% over the 5 year, and it didn't include dividends. So that would have even boosted these numbers even more. So for solid positive returns to play out, earnings growth is going to have to be strong. So Doug, what's the outlook for earnings?
So the outlook is very, very optimistic. So what we have here is Jerry Maguire saying, show me the money, because that is basically what the analysts are projecting in terms of earnings growth. So now you have to remember that when they make these assumptions, they're coming off of presumably low levels from last year when things kind of bottomed out. But these are very, very large numbers. So for the first quarter, you have S&P 500 companies so far that have reported earnings of approximately 30% and a 7% growth in revenue. Now, we're maybe a little bit before halfway through earnings season, so that number could adjust. But as of now, that's a large number in earnings growth. So looking forward, the second quarter analysts are projecting 54% equity growth. For the third quarter, 20%. For the fourth quarter, 15%. And then for the entire year of 2021, that blends to be approximately 27.9%. I believe that would be the highest growth year since 2010, which makes sense because if you remember 2010, that was the year that we were kind of coming out of the Great Financial Crisis, the Great Recession. So the comparisons to basically basement level earnings were much higher. But one of the things that we had on the previous slide was this idea that in the second year of a bull market that you can see PEs contract. So what happens is you get this blast in earnings growth. And then the other side of that is that prices either drop or they just stay the same. So what happens is the P doesn't move, but the earnings go up. So what happens is you essentially get a PE contraction. And we think that is certainly possible in a scenario that we're seeing right now in the market. So how do returns look year to date? We've talked a lot about value. We've talked a lot about small cap. We've talked a lot about growth. And we've talked a lot about just broad market in general and even international to a certain extent. So year to date, up here, we've got the iShares value factor. So we've talked a lot about allocating money towards value with the idea that the economy is going to continue to grow. We're going to see the possibility of inflation go up and the possibility of rates moving higher, which historically has benefited value assets. So far, that has been the top performer year to date. Then we move down here to the Russell 2000, which is simply small cap, broad market here. And then you have both growth and international at the bottom. So one thing to point out, though, is all these returns are still very good. And we're going to kind of get into expectations here in a little bit. But one thing to notice is that since I think it was around March 8th or 9th, you had the trajectory that we saw for interest rates kind of level off and come back down a little bit. And since then, you've seen a little bit of change in the pattern of returns. So you've seen value level off, you've seen small cap coming down, while you've had the market continuing to go up, you've had international go sideways, but really you've had a growth resurgence right here. And what we've seen is these kind of daily, trading kind of trade-offs, so to speak, between days when rates go down, growth does really well. Days when rates go up, value does really well. So a lot of this is tied to COVID cases or economic data, but we seem to be in a very back and forth environment right now where one day value takes the leadership, one day growth takes the leadership, one day rates move up, one day rates move down. Now, that's not abnormal when you're seeing some of these longer term trends, which I certainly think, and we've mentioned this before, that we're starting to see the trend of value outperforming growth. But along the way, you're going to have some of these periods where you kind of have counter rallies to the main trend, so to speak. So we don't necessarily think that this is a change in leadership, but it's certainly not surprising to see growth gain some ground against value and small cap over the past few weeks.